Hello, my name's John Gullo, Chief Investment Officer of Sanderson Wealth Management, and I'll be walking you through this quarter's 15-minute financial update. Please remember, you can pause, rewind, or stop the presentation at any point in time. The third quarter of 2019 was characterized by increased trading tensions, geopolitical instability, slowing global economic growth, and increased stimulus from central banks. While much of the news flow is negative, additional stimulus from the U.S. Federal Reserve and European Central Bank helped neutralize concerns, ultimately leading to a flat quarter for global stocks as a whole. Within the more interest rate sensitive asset classes, the central bank stimulus helped to boost returns for real estate, infrastructure, as well as both taxable and municipal bonds. As mentioned a moment ago, global stocks as a whole were virtually unchanged during the third quarter, falling just 0.03%. When we dig a little deeper, however, there was quite a bit of discrepancy, with U.S. stocks rising and foreign stocks falling. Interestingly, this difference can be largely explained by changes in the value of the U.S. dollar. The U.S. dollar rose 2.5% during the quarter when compared to the currencies of our foreign trading partners. As such, if we look at stock performance in local currency terms, returns look a little better. Performance of foreign developed stocks changed substantially and outpaced their U.S. counterparts, while emerging market losses were cut in half. Now, fluctuations in the value of the U.S. dollar are not a new phenomenon. In fact, the dollar has been rising since the beginning of last year. Should this trend reverse, however, U.S. investors who hold assets overseas will see the change in the currency help performance rather than hurt it. To keep the U.S. economy strong in the face of some notable developments, Chairman Powell and the Federal Reserve announced 2019's second interest rate cut on September 18th. Similar to the first cut, which took place earlier in the year, this step was taken as insurance against ongoing risks. As a result, short-term interest rates are now back below 2%, a move that was applauded by borrowers but criticized by conservative savers. With the U.S. economy performing better than either Europe or Japan's economy, it is not surprising that some additional steps have been taken to boost economic activity there. What is surprising, however, is the degree to which the foreign central banks are easing. We just discussed how domestic short-term interest rates are now below 2%. But in both Europe and Japan, those same interest rates are below zero. In addition, both the European Central Bank and the Bank of Japan have purchased trillions of dollars of assets to help push cash into the marketplace, hoping to grow their respective economies and drive inflation close to their 2% target. These significant purchases have increased the size of both central bank balance sheets to greater than $5 trillion each. To put this in perspective, the Eurozone economy is roughly $13.7 trillion. But Japan's economy is less than $5 trillion. That's right, following a half-decade spending spree designed to accelerate weak price growth, Japan's central bank has become the first among major industrialized nations to own assets collectively worth more than the country's entire annual economic output. We discussed how short-term interest rates are negative in Europe and Japan, but what about longer-term interest rates? Well, interest rates on 10-year government bonds are low throughout the developed world. In fact, in several areas they are negative. That's right. Buying a 10-year government bond in countries like Germany or Switzerland will result in a guaranteed loss if held until maturity. Yet there continues to be people willing to do so. Why? Well, they're hoping that bond prices will go up in the short term and they can make a quick profit. The problem is, interest rates need to fall further into negative territory for that to happen. So, in today's crazy environment, a speculator, notice I did not say investor, a speculator who buys a German bond at a negative 0.6% interest rate is expecting that interest rate to fall to negative 0.7% or negative 0.8% or even lower sometime in the future. The low interest rate environment is making it difficult for investors to find bonds that pay a reasonable amount of interest. As such, investors are looking increasingly at riskier bonds to help bridge the gap. Now, this could mean a corporate bond that is still rated investment grade, or something a bit riskier in the below investment grade space. The problem we face when looking in these areas, however, is we are not being properly compensated for the additional risk. Today, investors who purchase A-rated corporate bonds would receive just 0.9 percentage points more interest than if they chose to buy a AAA-rated guaranteed U.S. Treasury bond. Historically, investors have received an additional 1.3 percentage points more in interest. Even if we look at below investment grade, also known as high yield or junk bonds, investors only receive an additional 2.3 percentage points for a BB speculative bond compared to a AAA guaranteed U.S. Treasury bond. Historically, that average has been 3.6 additional percentage points. As such, even if an investor is willing to take on additional risk, they are not being properly compensated for doing so. Energy markets were quite volatile in the month of September following drone strikes on two major Saudi oil facilities. The pre-dawn attacks on September 14th knocked out more than half of the producers' output. Following the attacks, oil prices spiked over 10% as supply concerns ensued. Meanwhile, the world waited to see if there would be a military response on either the terrorist group who claimed responsibility or on the country of Iran, who U.S. government officials believed was ultimately operating behind the scenes. Tensions eased after a few short days when Saudi production recovered and the U.S. decided to implement economic sanctions rather than military actions against the country of Iran. Over the past several months, corporations, economists, and market participants have been concerned that trade tensions between the United States and many of its foreign trading partners would lead to a slowdown in global trade. While results have not been devastating to date, global merchandise trade has fallen 0.2% thus far in 2019. When we break down trade geographically, as expected, it is the emerging economies that are suffering more than the advanced economies. What is surprising is China. China's exports have actually increased year to date. Many economists believe, however, that should trade tensions continue to accelerate in the months to come, to the point that an increasing number of U.S. corporations move production of finished goods, or even components of those finished goods to other countries, it is unlikely business elsewhere in the world will be enough to offset the loss for China. Although global trade is only down slightly this year, other geopolitical and economic concerns are leaving investors worried and looking for insight into the future. One area which can provide some insight is reviewing leading economic indicators. These are data points such as retail sales, inventory levels, building permits, and unemployment claims that can help provide information about the future health of the economy. Plotted here, you can see recessions over the past 50 years. You can also see that the composite of leading indicators has fallen prior to each one of these recessions. Now, sometimes it falls sooner than others, and sometimes it gives a false positive. Nevertheless, it is a useful tool. Should this indicator continue to fall over the next several months, it would be a signal that economic activity is likely to continue slowing in 2020 for both the U.S. as well as the global economy. Turning to corporate earnings, earnings for companies included in the S&P 500 index have experienced great growth over the past few years, thanks in part to tax law changes and share repurchases. But how about for 2019? Well, S&P 500 profits are showing reasonable growth thus far in 2019, up 4.3% compared to the same period last year. That is 2.5% above the inflation rate. Unfortunately, if we expand the data set beyond the S&P 500 to include all U.S. corporations, profits do not look so good. They are actually down 0.8%. This, as well as the fact that analyst consensus for full year 2000 earnings for the S&P 500 continues to be revised downward, tells us that the big increase experienced in 2017 as well as increases in 2018 are unlikely to continue. We talk about volatility a lot in investing. Volatility measures the frequency and magnitude of price movements. The more dramatic the price swing, the higher the level of volatility. One way to measure expected volatility is with the CBOE Volatility Index, also known as the VIX. In much of 2017, the Volatility Index hovered around 10, often just below or just above. A level of 10 on our fear gauge tells us that investors were expecting little to no volatility. In 2018, volatility was a bit higher. Specifically, in the fourth quarter of 2018, the level averaged 21, but was as high as 35 on Christmas Eve. At that time, investors were scared and expecting a 10% or more price swing in the next 30 days. For much of 2019, the level has averaged just over 15, but today it's closer to 20. Investors are neither as giddy as they were in 2017, nor as concerned as they were in December of 2018. Mathematically speaking, investors are a bit skeptical today and believe prices could rise or fall by roughly 5.5% over the next month. Speaking of fear, there is still no clear path for Britain in its quest to leave the European Union. Earlier this year, Theresa May was unable to secure the necessary votes to pass her Brexit agreement, which led to her resignation and the beginning of the Boris Johnson era. Early on, Boris had some successes and some failures. He managed to secure approval to suspend Parliament, but then proceeded to lose several key votes, including a provision which makes it unlawful to leave the European Union without a deal, the so-called no-deal Brexit, as well as the defeat in his quest to secure new elections and bring in like-minded members of Parliament. Things went from bad to worse for Boris when the UK Supreme Court forced the reopening of Parliament so debate on Brexit could continue. Next, Mr. Johnson published a new plan which offered a solution to the Irish border conundrum, only to have that plan dismissed days later by the lead negotiator for the European Union. This rejection took place days before their scheduled meeting on October 17th and 18th. Now, with only little time remaining before the 10/31 deadline, the world will be watching to see if a deal can be struck, an extension is requested, or a no-deal Brexit actually occurs. Lastly, we'll talk about the federal debt level. In early 2009, the Congressional Budget Office released a 10-year forecast for government debt. At that time, total public debt stood at $10.6 trillion, and annual deficits were projected to start at $700 billion and gradually fall to a modest $235 billion. As such, total public debt was forecast to increase gradually to $16 trillion by the end of fiscal 2019. To say the forecast was a bit off would be an extreme understatement. Changes in laws surrounding both taxation as well as spending led to multiple trillion-dollar deficits over the past 10 years, which over time led to $6.7 trillion of additional borrowing, beyond which was forecast. With the current debt level at $22.7 trillion, up $1.2 trillion from the prior year, and now forecast to increase an additional $11.7 trillion over the next 10 years, the burden we are placing on future generations is quite concerning. Thank you for watching this quarter's 15-minute financial update. Enjoy the rest of your day.